Okay, this week I always like to put the list of activities on the board over here to the right, and I'll usually have more than this just up here, but roster and intro we've done, syllabus, gone through Wiley Plus, and now I'm just going to kind of give you the last bit of class, kind of an overview of accounting in the business world, and then starting on Thursday we're going to start in on the real accounting for stuff, actually doing transactions. But before we do that, it's kind of good to have just a little bit of a background. And that's what we're going to do now. Okay. It's a lot. Sometimes I'll do this, sometimes it's easier if I write it on the board, but I like to have the option to do both. The purpose of accounting. Why do we even have to have it? Well, if we don't have the accounting aspect of a business, it's hard to tell how the business is doing. Do they have money to pay creditors? Do they have money to go out and keep the business, go out and buy new stuff? Do they have a good enough customer base? So, to help people make business decisions, and the people who are going to make these business decisions are called stakeholders. Who has some kind of a claim in the business? Stakeholders is not the same thing as a stockholder. And it's not the same thing as a hamburger holder. Stakeholders. So stakeholders include the owners. Of course, they're one of the biggest ones. The upper level management, of course. A big one, creditors. You're not going to be able to go take out a loan if you can't provide some kind of financial basis on how the company's doing. The IRS is going to want to know how the company's doing. So say you want to go work in accounting, and you think, well, where could I work and do accounting? Well, there are three main options. The public sector is what you would think of if you heard of Vinesky and Sons CPA office. You're down on the corner street and see the sign Vinesky and Sons, and we do the taxes for any companies, and we look at getting your financial records put together, doing your payroll. Okay, the public sector is, I'm going to, as a business, look at a whole wide range of businesses and do the accounting for all kinds of. I'm going to do it for the construction people. I'm going to do it for the dentist office. I'm going to do the books for a gas station, for maybe the local subway franchise. So with this public sector, these guys here know a little bit about a lot of stuff. Not really an expert maybe in any one area, unless that's what your business does. You expert only in the financial side of estates. Doing estate accounting. The private sector would be Eli Lilly hiring out and hiring an accountant to do just Eli Lilly books. And even more specific, Eli Lilly would probably hire, or does hire, somebody that does just mergers and acquisitions. Eli Lilly buys another company, well, there's a lot of tax aspects that go with that. And different financial items that have to be done a certain way. and that individual or section of the company would only deal mergers and acquisitions. And then one group would only do payroll, and only do, a lot of companies have payables and receivable sections, but companies that are really, really big have people who specialize. They know a whole lot of stuff on a little tiny area of the business. That's the private sector. But the private sector, you basically just work for one company. The not-for-profit side, or the government side. Maybe you want to do white-collar crime and work in the FBI. That was what I was planning on doing when I first got out of school, until I found out that people in the FBI don't have very good family lives. So that didn't appeal to me too well. Or you want to work as an IRS agent, or at United Way, not-for-profits. Some different areas where you can work as an accountant. So if you want to start up your own business, not that you're going to do accounting, you just want to start up your own business as a local weatherman. Do you know BAM Chase?
I know BAM Chase.
And Indiana Weather Online? You follow those guys?
We follow each other.
Yeah. So I follow them too. Basically one owner. Good and bad to being a one owner. You make your own rules, your own boss, but it's hard to raise money. And I saw a stat that about 70% of businesses are of this type. So 70% of businesses, and you can be a sole proprietor even though you own a franchise of Subway. You own, with almost all Subways, they're franchise owned, meaning that you or I could go out and buy the rights to use Subway equipment, but we're still a single owner for financial purposes. We bear the risk. And what I mean by LLC, if you drop the class after today and this is the only thing you get out of it, if you ever start up your own business, make sure you take the extra step and pay the yearly fee to the state to make your company a limited liability company. This protects you personally from anybody that may sue your company on a business standpoint. If you are not set up as an LLC, it's kind of like an insurance, and something bad happens through your business, the person that had that against them can go sue your business and sue you personally and take your home, your car, whatever else you have to your name. You have this set up with the state. You apply and you get to be an LLC, a limited liability company. Then that person can only sue your business and whatever the business has in their name, not you personally. Don't learn the hard way on that one. It's not worth it. Partnerships have the same protection. Limited liability partnerships. 2 or more people come together to start a business. So this just has one owner, 2 or more owners. And then finally the biggies, the corporations issue stock, so there's a whole bunch of owners, especially if it's a C Corp. Even though only 20% of the businesses are of this type, 90%, so out of every $100 that is generated in the revenue, 90 of that 100 went to the corporation's pocket. The rest of the $10 was split and given to these guys, the small businesses. So even though there's not as many of these, they make the most money. The Walmart and Target. Corporations have their own protection. This And the LLP was to make these guys more even with corporations. Corporations have their own thing, and we'll talk a lot about that later in the class when we get to corporations, have their own protection against liability. Okay, just a couple more things and then we'll finish up for today. Oops. Second thing, if you get out of this class for today, besides the LLC, is to know in accounting you have to follow a set of rules. If you don't have this set of rules, then everybody's books could all be different, and nobody can really, you can't say, I have two different accountants doing the books for the same company. One says, oh, your revenues this year were $50,000. You did an okay job. CPA B says, oh, your revenues aren't $50,000. They're $75,000. You did a great job this year. And the owner would be like, well, who's right? And owner A says, well, I'm right because this guy, B guy, counted revenues that you haven't done work for yet. That's just people who've paid you in advance, like rent, maybe. You pay rent, you pay insurance in advance. And B guy said, yeah, we got the money, that's revenue. And A guy said, well, we got the money, but we can't count that as revenue. Well, somebody's got to be right. We can't have two different competing. So GAAP says, okay, this is the way that we're going to count, so everybody does revenues the same way and expenses the same way. And we're going to talk about which way is right. Person A is actually the right way. You have to have the money or been promised to be paid and done the work. Just because you get the money doesn't mean it's considered revenue. So one thing I definitely want you to get out of this is the set of rules, generally accepted accounting principles. GAAP. Generally accepted accounting principles. So when you're an accountant and you're filling out things for maybe the clients to look at, your bank, to see if you can get money, if the stuff you fill out is so complex that not even a CPA or somebody trained to look at it can understand it, it's useless. So when it's understandable, doesn't mean it's understandable to, I guess, go pick off somebody down the street who's never learned accounting. No, it doesn't have to be understandable to them. It has to be understandable to somebody like myself or somebody who has a background in accounting work. If it's not understandable to somebody like that, then it's just mumble jumble, doesn't mean anything, and it's not objective. It needs to be useful, so it's understandable. And what I mean by useful, well, one, it's got to be relevant, meaning it doesn't do me much good if you just closed your books from 4 years ago. It doesn't really help me make a decision on how the company's doing now. And reliable. If I have two different people, like I said earlier, doing the same books, they better come to about the same answer. So is your information relevant and reliable? Last two things. Accounting stuff needs to focus on what's material. You don't want to get bogged down with the small, little, teeny, tiny details of, I just bought a new eraser. Okay, do I need to capitalize this and put this on my books as, on my balance sheet, I own an eraser? No. We group these kind of purchases together and say, I bought supplies, and we just kind of call it that, supplies. But if you bought something big, maybe like a computer workstation, that's something that's material to a small business. It costs a good amount, but Maybe to some company like Eli Lilly, one computer, not a big deal. Maybe that's not really all that material to them. So it just depends on the business. What's material to you? You still got to keep track of all the dollars you spend, but we don't have to necessarily show that it was exactly this eraser. If you get what I'm saying. It's got to be material to report it specifically on the books by itself. Last, in accounting, you have to be conservative. If you don't know if something's going to happen or it's kind of iffy, you report it as though it's not going to happen, or you're not going to get that money, or that expense will happen. You never take the better route that just makes you look better. You can't do that. That's setting yourself up for nice big lawsuits. Choose the least profitable option. So if you have inventory on your books and you don't know if you should write it down because, well, it's kind of worth $10, but I just don't think I'm going to ever get $10 for it, you have to write it down to what you think you would sell it for. Now it's only worth $8. Conservative. Okay, for Thursday, make sure you have printed off the Blackboard things. There's at least 4 things to print off, but print off more than one sheet of the T account. And we're going to go through the 2 transaction pages, doing some examples, going through one of the Wiley Plus examples on there as well. If you don't want to print them off, if you have a laptop and you want to bring that in instead, that's fine too. I mean, usually printing them off so you can write right there on the paper is good, but you don't have to do that. If you want to bring in your laptop, that's fine. Other than that, there's nothing really due for Thursday. Just bring in that Blackboard stuff and begin to set up Wiley Plus. And I'll see you on Thursday.